7 ways to achieve financial freedom. Achieving financial freedom is a goal for many, yet it requires strategy, discipline, and an understanding of personal finance. Here are 7 strategic ways to move toward financial independence. 1. Start early. The power of compound interest. The cornerstone of building wealth is starting early. Time is an investor's best friend, thanks to the magic of compound interest. Compound interest is the interest on a loan or deposit calculated based on both the initial principal and the accumulated interest from previous periods. The earlier you start saving and investing, the more your money grows over time due to this phenomenon. Albert Einstein called compound interest the 8th wonder of the world. Example, if you start saving $100 a month at the age of 20, with an average annual interest rate of 7%, by the age of 60, you would have accumulated over $240,000. However, if you start at 30, you would accumulate about $120,000 by 60. That's half the amount with just a 10-year delay in starting. You should also understand the Rule of 72 in compound investing. Introducing the Rule of 72. A handy tool to understand compound interest is the Rule of 72, a simple formula that estimates the number of years required to double the invested money at a given annual rate of return. By dividing 72 by the annual rate of return, investors can get a rough estimate of how many years it will take for their initial investment to duplicate. 2. Save aggressively. The importance of budgeting. Saving as much as you can is crucial. Budgeting is the tool that enables you to track your expenses and maximize your savings. It's not just about cutting costs. It's about being smart with your money. Illustration. Consider the habit of buying a $5 coffee every workday. Over 20 years, this adds up to $26,000 without accounting for potential interest. If instead, you invested that $5 daily at an average annual return of 7%, you would have over $37,000 after 20 years. This example highlights the impact of seemingly minor spending habits on long-term financial growth. So before buying anything, we should ask ourselves, do we really need this? This can cut out many of the unnecessary expenses in our life. Once we consciously do this for a period of time, we are able to form a habit of it, and it will go a long way in helping us achieve financial freedom. 3. Invest in quality assets. Hedge against inflation. Inflation erodes the purchasing power of money over time, making it vital to invest in assets that appreciate in value. Quality assets like real estate, stocks, or index funds not only provide a hedge against inflation but also grow in value, offering a return on investment that typically surpasses the inflation rate. For example, buying a house with good services like shops, schools, and transport links will generally be sought after over the long term and will appreciate in value more than the inflation. Unless our assets grow in value over above the rate of inflation, we will not be able to build wealth. 4. Income-generating investments. The cycle of compounding. Investing in assets that produce income, such as rental properties or dividend-paying stocks, creates a virtuous cycle. The income generated can be reinvested to purchase more assets, which in turn generate more income, thereby accelerating the journey to financial freedom. 5. Leveraging debt strategically. This refers to the strategic use of borrowed money to enhance investment returns. When executed wisely, leveraging can amplify the potential gains from an investment. However, it's important to note that while leveraging can increase the potential for profit, it also increases the potential for loss. Thus, understanding the nuances of leveraging debt is crucial. Robert Kiyosaki's perspective on using debt. Robert Kiyosaki, author of Rich Dad, Poor Dad, offers a distinct viewpoint on debt, distinguishing between good debt and bad debt. According to Kiyosaki, good debt is debt that you take on for the purpose of investing in assets that generate income. In contrast, bad debt is associated with purchasing non-essential items or depreciating assets that don't generate income and may lose value over time. Good debt. Kiyosaki argues that savvy investors use good debt to their advantage. For instance, taking out a mortgage to purchase a rental property is considered good debt, as the property generates rental income and has the potential to appreciate in value over time. The key is that the income from the investment, the rental property, in this case, should not only cover the debt service, mortgage payments, but also generate additional cash flow. Leveraging in real estate. Let's illustrate Kiyosaki's concept of leveraging debt with a real estate investment example. Suppose you obtain a mortgage to buy a rental property. The rental income you receive each month covers the mortgage payment and additional expenses, and there's leftover cash that constitutes your profit. Over time, as you pay down the mortgage and potentially benefit from property appreciation, your equity in the property increases. This is a strategic way to use debt to build wealth. The power of leverage. Kiyosaki emphasizes that leveraging allows individuals to purchase larger assets than they could with only their available cash. It's a way to use other people's money, in this case, the bank's money, to generate returns. The increase in your investment return in proportion to the debt used is the leverage effect. However, Kiyosaki also cautions about the risks of over-leveraging. It's vital to have a clear understanding of the cash flows and to ensure that the income generated from the asset consistently covers the debt servicing costs. Moreover, investors need to be prepared for market fluctuations that might affect their investment's income-generating capacity or value. Leveraging debt is a powerful strategy when used judiciously, particularly in investment opportunities where the expected income outweighs the cost of debt. Robert Kiyosaki's approach highlights the importance of discerning between good and bad debt, encouraging individuals to harness debt to acquire appreciating assets. This strategic approach to debt can significantly accelerate wealth building, but it requires careful planning, a deep understanding of the investment, and an awareness of the associated risks. 6. Continuous learning. Diversifying your income through passion and skill. The concept of continuous learning is pivotal in personal development and financial growth. Jim Rohn, an eminent motivational speaker and author, emphasized the value of personal development and the significant impact it can have on one's income and life. Rohn believed that formal education would make you a living, but self-education would make you a fortune. This philosophy underscores the importance of continuous learning in diversifying income and enhancing financial stability. Embracing lifelong learning. Continuous learning involves consistently upgrading your skills and knowledge, not just for professional advancement, but for personal growth as well. This approach aligns with Jim Rohn's teachings, which encourage individuals to work harder on themselves than they do on their job. By investing time and resources into learning new skills, especially in areas you're passionate about, you open doors to opportunities that were previously unavailable. Diversification through skill enhancement. In today's dynamic world, relying on a single source of income can be risky. Diversification, a term often associated with investment, is equally relevant when it comes to income sources. By acquiring new skills and tapping into your passions, you can create multiple income streams. This not only provides financial cushioning but also ensures that you're less vulnerable to economic shifts. Turning passions into profits. Jim Rohn advocated for the pursuit of passion, suggesting that success is more likely when you're engaged in work that you love. By focusing on areas you're passionate about, the process of learning and skill acquisition becomes enjoyable and fulfilling. This intrinsic motivation can drive you to excel and potentially turn your passion into a profitable venture. Examples of skill-driven income diversification. Digital skills. In the digital age, skills like web development, digital marketing, and graphic design are in high demand. Learning these skills can open up freelance opportunities, consultancy roles, or even the foundation for your own digital business. Art and creativity. If your passion lies in the arts, continuous learning can help you refine your craft, whether it's painting, writing, or music. These skills can translate into income through teaching, selling your work, or performance gigs. Investment and financial management. Acquiring skills in investment and financial management can not only improve your personal finances, but also open opportunities for advising others, managing funds, or creating financial content. The impact of continuous learning on financial freedom. Jim Rohn's philosophy highlights that the quest for financial freedom is intertwined with personal development. By continuously learning and expanding your skills, especially in areas you're passionate about, you not only enhance your employability and earning potential, but also align your work with your interests and values. This alignment can lead to greater satisfaction and, ultimately, a more fulfilling and financially secure life. Incorporating continuous learning into your strategy for financial freedom is not just about income diversification. It's about personal fulfillment and leveraging your passions for financial gain. As Jim Rohn beautifully articulated, the investment you make in yourself pays the best dividends. By embracing lifelong learning and skill acquisition, you position yourself to navigate the ever-changing economic landscape, turning your passions into profitable endeavors and moving closer to financial independence. 7. Tax-efficient saving. Maximizing investment growth. Utilizing tax-advantaged accounts can significantly impact long-term financial growth. These accounts, such as IRAs or 401(k)s, offer various tax benefits that can enhance the growth of investments, making them indispensable tools in the quest for financial freedom. This is especially true for higher-rate taxpayers. Conclusion. Achieving financial freedom is a deliberate process that requires a comprehensive and disciplined approach. By starting early, saving aggressively, investing wisely, leveraging income-generating assets, using debt strategically, continuously enhancing skills, and utilizing tax-efficient saving strategies, individuals can build a solid financial foundation. Each strategy plays a crucial role in creating a sustainable financial future, enabling individuals to not just accumulate wealth, but to achieve a state of financial well-being where they have the freedom to make choices that align with their values and life goals. We hope you liked this video, and if you liked it, please like and subscribe.